Welcome to the Creating Wealth Simplified podcast. My name is Lauren Wells, here with my co-host, Chris Seveney. We're committed to providing you with the knowledge required to build wealth through real estate investing. Tired of consuming content about real estate? Stuck in analysis paralysis? Ready to do your first deal? As a member of our community, you will learn how to go from consuming content to taking that first step into the world of real estate investing. Our show is not about getting rich quick, but about providing you with the knowledge you need to take action. Join us as we speak with experienced investors who share action tips on how to escape the corporate world, start a thriving side hustle in the world of real estate, and go beyond your W-2 or 401k.
In this episode, we interviewed Brian Burke of Praxis Capital, also author of The Hands-Off Investor, a book about questions to ask and really research when looking at investing as a passive investor. For those that don't know Brian, he runs a multifamily firm. He has over 30 years experience, and it topped out at about 4,000 units. And Brian, throughout his career, has been able to really understand the markets. And what I loved about this episode is we talk about what he did pre-Great Financial Crisis, during COVID, where he was liquidating assets, and similar philosophies of why he knew the timing of the market. So this was a great episode where Brian is just a wealth of knowledge on the real estate front. I loved the conversation, as myself being in real estate for 25 plus years, got to nerd out a little bit over some of the things we see, some of the things that we've seen go wrong, some expectations of where we see the real estate market heading in the upcoming years. So definitely check out this episode. Actually, one of my favorites, having Brian on and really just talking about, real estate syndications and where we see things headed. So hope you enjoy this episode of Creating Wealth Simplified podcast. Brian Burke, how are you doing today?
I'm doing great, Chris. Thanks for having me here.
Yes, it's a pleasure to have you on the show. And as we talk real estate, which we both are very passionate about, as we both contribute pretty significantly to forums on Bigger Pockets. As I mentioned intro, you've got a lengthy past in real estate and also wrote a book, about being a hands-off investor. And why don't you tell people what you're doing today, but I'd also be interested to what spurred the book and what got you in real estate. So you can start where you are today, but kind of then let us know how you got to where you are today.
Yeah, well, where I am today is I'm not doing a lot because the commercial real estate market started collapsing in around 2022, so about 2.5 years ago. Just prior to that, I started selling most of my multifamily portfolio, and I sold 3,000 of the 4,000 units I had between 21 and 22. Right before the market started tanking. So since then, I've been of course, managing the hell out of the 1,000 units we do still have, but not having to spend a lot of time looking for additional assets because there was just no viable thesis for making new investments in multifamily over the last couple of years, which has resulted in the first time in my 35-year real estate career that I'm not running 100 miles an hour with my hair on fire. And I'm actually kind of really liking that. So, I like to tell people that there's a good time to buy, there's a good time to sell, and there's a good time to sit on the beach. This is a good time to sit on the beach for the last couple of years, and I've been making good on that promise. I like to follow my own advice. But how I got here, of course, came through a lot of the stuff you talked about in the intro. But, I started out as a house flipper 35 years ago and grew my business into multifamily about 20 years ago and have been investing in multifamily ever since. And, we've got a broad client base of high net worth investors that have invested with us. And I'm just here to produce a result for them. And if I don't think the market is conducive to producing a result like that, then I sit on the sidelines and watch all the shenanigans from the grandstands.
It's interesting that you mentioned the time to buy, time to sell, and time to be, a ticket holder and watching the game go on, because there's a lot of people out there either pushing, oh, you should sell, or now's the time to buy, or start raising money to buy new assets. And I'm of the similar opinion as you are, is kind of let's continue to let the dust settle a little bit, because it's still, I think, a lot to be settled in that standpoint. And One of the interesting questions I do want to ask you, though, you mentioned you sold a lot of your units prior to 2022. Do you think you'll buy any of them back at less than you sold? Because I was involved in a construction project back in early 2000s, or actually late 90s, that an apartment developer developed it, got it 95% occupied, sold it for a ridiculous price. Then as the market turned, I think it might have been 2001 or two, where it slightly started to come down because of the tech bust, bought it back at 60 cents on the dollar, and turned around and sold it again in like 2006 for really like more money. So I'm just curious, do you think you'll end up in a similar situation where the potential might be an opportunity to pick up something that you sold?
Probably not. I've actually done that before. So that is an interesting strategy. And we did have one property that we made an offer on and got it accepted in 2021. And then the seller at the last minute decided, you know what? We're not going to sell. We're just going to keep it and sell it for more next year because your offer really isn't high enough. And I was a little frustrated with them at the time, but I couldn't be more glad now. So here we are 2.5 years later. They came back to us wanting to know, well, we still own it. Will you still buy it? And we made another offer, $20 million less than our previous offer. So that wouldn't be quite a buy it, sell it, and buy it back, but it would have been kind of an interesting story if they would have accepted this latest offer, which they didn't. But I have had that opportunity to buy back property before. This time, I don't think it's going to happen. We've had 3 of the properties that we sold, the sellers, or I should say the buyers, have come back wanting to know if we would buy it, not realizing we were the ones that sold it to them. And we declined in both cases because they're trying to sell them for the loan amount. The properties aren't even worth the loan amount. So maybe down the line, values could come down low enough and lenders could get desperate enough where we could see ourselves buying something back. But a lot of the stuff we sold for, in addition to market reasons, that we saw that the market was going to have some issues and it was a really opportune time to be a seller. Part of the strategy of selling had to do with the fact that we were changing the style of properties we were interested in. Now my oldest property was built in 2000. We used to buy 80s product. We had some 70s product, and we just don't do those older projects anymore. Now we're primarily focused on more Class A and newer stuff. So would I want to get back in that business? Not enthusiastically.
So, everybody can be a Monday morning quarterback, and, it's easy to look in a crystal ball from the past. You mentioned, several strategies. One is you're just changing asset class, but you kind of hinted that you thought you saw some cracks in the market. What were, back when you were looking at things, 3 years ago, what are some of the things that made you view the risk profile on these assets was increasing? Was it interest rates, or was it just the price things were selling for? What are some of the things that you saw back then that were creating concern for you?
Yeah, interest rates really had nothing to do with it because at the time we were selling, interest rates were still quite good. They hadn't started going up yet. What was concerning to me was when we were trying to buy stuff, we were getting outbid by millions and millions and millions of dollars by other bidders who were putting up 7-figure non-refundable earnest money deposits, which it's like, wow, if people are willing to do that, maybe they'd be willing to do that for some of our properties. Lo and behold, we get an unsolicited offer on something that was way above what we would think it should ever sell for. So we took that offer and then decided to start seeing if we could get similar results with some of our other assets in our portfolio. So then we started strategically and intentionally selling them, and we were getting those results. We were getting incredible prices. So really what a lot of it had to do with was an observed irrational exuberance on behalf of buyers in the marketplace, where the best time to be a seller is when everyone wants to be a buyer. And in 21 and 22, everyone wanted to be a buyer. And if they want to pay exorbitant prices for our assets, far be it for me to stop them.
No, it's reminds me of a story where in 2004, and I was up in New England working for a commercial general contractor, and they had a Florida office as well. And that was the time where high-rise multifamily and condos were booming in Miami. There's tower cranes everywhere. And during one of the quarterly meetings, the owner of the company made an announcement that, hey, we're not doing any more multifamily in Florida. We're going to pause multifamily in Florida. Caught everybody off guard because it's like, what are you talking? Why wouldn't you? And he told a story that he met with two developers. who were just out of college and they had no construction experience and they had entitlements and ground under contract and they had bank financing and mezzanine financing to build 250 units. And these people had zero experience, had no idea what they were doing, no idea whether the numbers worked. And he realized that if it's that easy to get money, then anybody can do it. People are going to be in a lot of trouble down the line. And he was right. I mean, Miami was one of the harder hit reasons people say, well, why'd you still get out? Is because the point come in time where half those projects stalled or didn't get completed. And as a contractor, how do you get paid if they file bankruptcy? So that was something that he looked into. And it seems just very similar to what you were saying is when things seem too easy, and I think most people think real estate was pretty easy the last several years, where you could have been out on a boat in an island with no internet and made money. It's people get lax or relax and it's like, oh, I can do this. This is easy. And I think that's something I see. And I'm curious if that's something not only in commercial side of things, but in residential, people you talk to, is that something you think you've seen over the last few years?
Oh, without question. Yeah. And that had something to do with our decision to sell too, is looking at what the buyer profile was. And we could tell because when we were getting offers on our properties, of course, you ask for buyer resumes and you see like these people really have no experience. They're raising money from people that shouldn't be trusting them with their money. And, kind of to your point, it was getting a little too easy. And that means that it's a really good time to be a seller. I saw the same thing in 2004 and 5 with the residential real estate market when I was a house flipper. Kind of the same thing where inexperienced investors were coming to real estate club meetings and going like, I got to get a rental house to buy. And I'm like, why? They're $500,000 and they rent for $1,500 a month. What's the point? But people had to have them. Well, my plumber made $1 million in a year on his house. And so that's when you realize, all right, it's time to get out. I stopped buying houses in 2003, late 03, and just barely just bought just a few in 04 and 05. And then the market started tumbling in late 05, early 06. So I missed a lot of that, downturn because you could see that there's going to be a lot of trouble down the road. And so these signs and symptoms appear every time this stuff happens. So it really was no surprise. I'd seen it before. And that's, again, part of the reason why I started selling.
Yeah, and I think it gets amplified on the multifamily side because there's that syndication out of Texas, Apple's Way or whatever it was, that had lots of trouble and they went under. And when you go and look at the resumes of the people who are affiliated with that, they didn't have a real estate background. I think they came from an IT world. I remember when it came in the news, the first thing I did is I went to the website and I just like looking into, okay, you've written a book on the hands-off investor and kind of done a lot of, education for people on, hey, how to invest passively. And, I like to share stories of, hey, what are the mistakes that, do the autopsy? And the first thing that I did is when I went to the website, I looked up the two sponsors and it's like, okay, where's the real estate experience? And then they had asset managers. In the asset managers, you click on their LinkedIn profile, virtual assistants. And I'm like, an asset manager and a virtual assistant are two very, very different things for anybody who knows real estate. And I used that to share with people. And I said, if you're going to look to invest in somebody, understand, what their background is. It's no different than when you go to get a surgery or a knee surgery. Like, you want a guy who's basically, never done it before? I wouldn't. And that's very similar to that investment strategy.
So are you saying that all that I'm hearing about, I can quit my job with no experience in real estate, raise money from investors that don't know any better, and work the 4-hour work week by delegating all of my duties to an offshore VA? That's not really a thing?
Well, today you don't even need the VA because AI will just do that. So you don't even need the VA.
Oh, okay. I gotcha.
No, it's interesting though. You bring that up because I know people who I'm friends with. And again, I invest mostly in defaulted notes. And when I left my full-time job, I had it planned out with my wife on how much money we have set aside and really had a strategic plan to be very conservative, because when you go into real estate, it's not a stream of your W-2 of money coming in the door. You might have good months, you might have bad months. And I've had people who have left their job to basically I'm going to go start a fund. I'm going to go raise money. And then they realize great, I raised $1 million. And it's like, okay, that's from your friends and family. But then that next hit after you hit your friends and family is, now how do I move it? And they can't. And then they realize, well, I got a 2% fee, so I'm making 20 grand a year. Uh-oh, now what do I do? And they get caught. So yeah, I mean, if someone wants to pay me $20,000 to have me spend a weekend with them to tell them that they can go quit their job, I'll happily do it. And I'll take a credit card. And at the end, I'll charge you another 40 to show you how to get back to your job after you fail, which is probably what a lot of these gurus do. Yeah, it's mind blowing to me. That's unfortunate too. It's like celebrities. It's like people, they're making more money, some of these gurus, being a guru than you will in real estate because people will go pay them 25, 50 grand. And to me, I pull my hair out because I went back, it was more for fun during COVID to go get a master's. I went Georgetown, did it over 2 years. And I think it cost me like 25, 30 grand. And I'm like, I'm learning for professors who 40 years experience running billion-dollar funds and talking with them where you're going to pay some guru 25 grand. And what's this person actually done? Person's 28 years old. It's like,
yeah, right.
In real estate.
Yeah, it's a tougher business than a lot of people realize. And when you said that you have good months and bad months, I'd counter that to say you have good years and bad years even. Yeah. I mean, there's times where you might go a year or 2 years without making any money, and you've got to be ready for that and set aside enough capital to run your life in preparation for those rougher years because they are out there.
Yeah. And I knew going in when I started that I wasn't going to make money my first 2 years in investing and doing what I was. Or if I did, it was just going to get reinvesting. And when you see people say, yeah, you're going to make $250,000 your first year. And I'm like, how?
Well, it's easy. You just charge a huge acquisition fee and then there you go, which that's actually true. But then if subsequently you just lose the property in foreclosure, then now you're done. You're out of business. You're never going back. You got investors suing you. There's all kinds of difficulty. There is a downside and a risk to this business that I think is underappreciated. It's a serious business. It's a business for people who are here to perform for their investors, safeguard capital, make smart investments, not just to earn fees, raise money, and own the most units. So your motivation for being in this business really makes a big difference.
We hope you're enjoying this episode of Creating Wealth Simplified. We wanted to take a moment and tell you more about our passive income fund at Seveney, which is open to both accredited and non-accredited investors. Our latest offering targets an 8% annual return distributed monthly with the ability to potentially achieve a greater return through our bonus share program. If you'd like more information, reach out to us at invest@seveneyinvestments.com to learn more. Thank you. Now, talking about that, you've written the book, The Hands-Off Investor, about the guide for, investing passively in syndications and stuff. And everybody that I know, basically, when they talk to people about, okay, how can I learn more about investing passively? That's the book everyone points to. So congratulations on that. My question to you is, why did you write the book? Like, was it one of these things where I want to do this, or was it something you were seeing in the space, or just people asking the same questions all the time? What was the motivation to write the book?
There were 2 or 3 main motivating reasons. One was I had a friend of mine who lost her entire life savings investing in a real estate syndication. And I felt like if there was one thing I could do to prevent that from happening to somebody else, then it would be well worth the effort. And hopefully this book has done that for somebody. Hopefully somebody didn't invest in one of these deals that has come crashing down in a ball of flames, and I've maybe prevented that from happening to someone. So that was part of the motivation. The other part of the motivation was, as a real estate syndication sponsor and a passive investor myself, but mostly as a syndication sponsor, I talk to a lot of passive investors, and they ask a lot of questions about our offerings and other people's offerings. And I was noticing that the questions that they were asking were in largely the wrong questions. I mean, they weren't asking what was really important. They're asking about things they think might be important, but they're missing a lot of the truly important stuff. And that prompted me to look into why does that happen? Why are so-called accredited investors, very smart people, college educated, degrees, like Ivy League, why aren't they asking the right questions? And what I found was there really was no source for people to learn how to invest passively and ask the right questions. And if you're going to write a book on something, write a book that no one else has written. I mean, you can there's 1,000 books on how to buy real estate with no money down, or how to raise money, or how to invest in apartments, all those kinds. There's thousands of those books. Why would mine be any different? I wanted to fill a hole that was unmet, and that was to write about something no one else has written about. And then at the same time all this is happening, I'm watching other sponsors out there raising bucket loads of money. And when I look at their offerings, I'm like, these offerings are crap. I feel like I'm sitting here watching cattle get led to slaughter, and there's nothing I can do about it. So if I can at least help educate passive investors, maybe they'll spot these things too, and they won't fund these deals that are doomed for failure. Unfortunately, I didn't catch everyone, because there's a lot of deals that are doomed and heading for trouble, and a lot of them that have already been foreclosed and had 100% wipeouts. See, I guess they say you can't save them all, but certainly, hopefully, I can help contribute to that.
Yeah. And there's also, for me, I put the two buckets of categories. There's the deals that, hey, the deal went bad and everyone has a bad deal. And then there's the deals that were just completely fraudulent in regards to some companies out there that are just completely committed fraud or Ponzi schemes and stuff. And one thing I think people need to sometimes temper a little bit is, and we see this a lot on forums, of a deal goes bad or someone does a capital call, and the first thing they go back to is, oh, this is a Ponzi scheme. And, I tell people, hey, calm down first before accusing. And I always recommend, don't accuse somebody in a public forum of, a Ponzi scheme, because if you damage your reputation and it wasn't, it could really come back to haunt you. Look into it, understand what's going on. And I think one of the bigger challenges we see today is some of these syndications and funds that are having trouble is they just completely lack communication. And I don't know if it's they've already got their fees, they don't care, they're trying to raise money somewhere else, whatever it is, or they're embarrassed. I don't know. But to me, that's where I've seen probably the most pain point is, it's one thing, hey, most people have experienced some type of investment that goes bad, whether it's in stock market or real estate or wherever, but at least you kind of have an understanding of what's going on. Today, I see a lot of people just not communicating, and I wonder if it's from lack of experience or I just don't know.
I think that the lack of communication comes from a lot of sponsors they'll bury their head in the sand because they're just incapable of delivering like harsh reality, delivering bad news. They don't want to do that. If they really say what's going on, they'll hurt their chances of raising money on their next deal. So they try to kick the can down the road and hope that everything's just going to be okay. I think that contributes to a lot of the communication problems. A lot of people that got into this business were maybe okay real estate investors, but not really fund managers. This is really a financial services business. It's not a real estate business. Essentially, like Chase Bank. I mean, Morgan Stanley. And I mean, you're a financial services business, not a real estate business anymore when you start taking money from people. So a lot of people don't know how to treat it that way. Kind of going back to another thing you were commenting on about how there was like, everybody gets a bad deal once in a while. Yeah, there's that. And then there's fraud, but there's also a third category. And the third category is just deals that should never have been done. And that goes beyond like everybody has a bad deal, because that's actually true. Everybody has a bad deal. And there's also bad markets that affect everyone. And we're experiencing that. We still own 1,000 units. The real estate market or the multifamily market's terrible. Rent growth has gone negative, and that's made things very challenging. If you navigate the challenges well, then you'll survive it. But some people don't know how to navigate the challenges well. But there's this other category of just simply deals that should never have been done. And these are the ones where they grossly overpaid for the asset. They financed it with high leverage, short-term debt. They layered on preferred equity. They put in senior share classes where they had like this split structure where their own investors were, some are class A, some are class B, and the class A's are in front of the class B's and all this other stuff. And basically all they're doing is they're layering on additional elements of leverage. And leverage does one thing. It amplifies results. And so when results are really good, leverage will make the results incredible. But when things are going bad, leverage will make it disastrous. And that's what we're seeing a lot of. And those aren't fraud. And they're not, oh, geez, we had a bad deal. Those are just deals that should never have been done, or at least not structured the way they were structured. And I think we're seeing a lot of that these days. And I think there's a lot of investors that are suffering as a result.
Sounds like some of the deals you sold probably may fit into that category,
Probably so.
That's a great feedback of, we were talking about this briefly prior to the recording, of people, just because you can raise money doesn't mean that you should for a specific deal, because if the deal is not a good deal, now are you forcing the issue? And, is it really going to be better for you in the long term? Yes, great. I got the acquisition fees and, the upfront fees, but is that really in the best interest for your investors?
Or even for you as a syndication sponsor. Yeah, okay, I earned a fee, but now I've got 5 years of absolute hell in front of me because I'm going to have to explain to the investors why things aren't working. I might have to tell them they've lost their money. I might have to deal with investor lawsuits and spend time in court and pay lawyers. It's just simply not worth it. You have to look beyond just whatever fee you might earn from this deal and put the investor's interest in front of all of that. If you do that, you'll make better decisions as a syndication sponsor, because you're only going to invest in something where you can be absolutely certain you're not going to have those phone calls, because that's a lot more uncomfortable than the comfort you're going to get out of receiving any of those fees. And I like to tell people, and I say this a lot, that it's so much easier to buy a bad deal than to get out of a bad deal. And it's so much easier to lose $1 million than it is to make $1 million. And I say this from experience. I've been through market cycles. I survived the great financial collapse without any investor losses, only because I structured things better than what I see a lot of people structure things. And I knew when to buy and when not to buy and when to sell and when to hold. And I think a lot of that is what contributed to that success. And I think I had deals where, not with investors, but in my own portfolio, which I bought, which weren't good deals, and took me, I've had some 20 years trying to get out of deals. And so it's very uncomfortable to get yourself into a bad deal where you have no exit. So the acquisition fee isn't worth it. It's all about whether or not that deal is going to perform long-term for investors. That's going to make your life as a sponsor a lot easier, and it's going to make it much better for your investors at the same time.
Yeah, I love that comment about debt and amplifying the results. And the other comment you made really that hits home a little bit too. Easy to raise, it's easier to lose $1 million versus make $1 million. And with some of these deals, like you said, how they keep stacking money on top of money. I actually watched a Big Short last week again because I was like, I haven't seen it in a while.
Right.
If you haven't seen the movie, it's got the Jenga blocks of the different tranches, and the lower, basically it's like the level of risk and where are you in that risk profile. But if you're just stacking junk on top of junk, it doesn't matter. And it seems like some of these syndications, that's really what they were doing, because the blocks themselves were faulty from the start. So it didn't matter how you layered them. They basically were going to essentially fail because it was a bad deal from the outset.
Yeah, in a lot of cases, you had two different diseases that were taking place at the same time. One is the disease of inexperienced sponsors that didn't have broad investor bases. And the other is the disease of maybe a little bit more experienced, but really wanted to grow and were really focused on AUM and unit count. And the result of both of those diseases was the same. What was happening was the newer people that didn't have a broad investor base didn't have a lot of depth to raise a lot of money in equity. So what they would do is they repurposed bridge loans, which were intended to take a non-performing property that didn't qualify for regular financing to a point where you could fix it up and make it qualify for regular financing and take out the bridge debt. They repurposed these bridge loans to become high leverage vehicles for them to be able to acquire large properties with raising only a small amount of money. And then the more experienced groups that were just focused on growth did the same thing for the same reason, that they could raise less money for each deal and buy more deals. And that, I think, is what's contributing to a lot of the problems, because if things go perfectly, that strategy, you can escape it. And people did. They were doing this in 2017, 2018 and getting away with it because 2019 and 2020, the market was up, they could sell. But when there's a dislocation in the market, it's going to expose all of that that's going on, and it's going to result in massive distress. And that's kind of what we're seeing now. And that's how we got to where we are, I think.
When do you think you'll see the light at the end of the tunnel in the multifamily side?
I think it's a couple of years. I think, construction is a headwind right now to rent growth, and we're starting to see starts are down by about half. Completions are still high because projects have been taking a long time to finish. So that's going to leave supply, I think, hanging until 2025. After that, I think we're going to enter a period where there's going to be a reduction in supply. New product will be lagging because it's going to take a while to get anything off the ground. So that's going to help on the rent growth front. Outside of that, really to get transaction velocity, you got to have numbers that make sense. And part of the problem is right now, there's still buyers that are buying at 5 caps in a 6% interest rate environment because they're hopeful that next year we're going to have 4% financing again. And there will be a time, I think, where sellers are going to have to realize like those interest rates aren't coming back. And therefore, cap rates are going to have to expand and they're going to have to sell at a higher cap rate. Buyers are going to have to realize they can't keep hoping for lower rates. They're going to have to buy at higher cap rates, and pricing will end up resetting to reality, not to hope and prayer. And when that happens, I think numbers will make sense, rent growth will make a comeback, and these deals will start to be viable again. I don't think we're there yet.
It was an election year. Whoever goes in there is going to fix housing or do this. And, by early next year, and I'm sitting here thinking, I don't foresee anything really changing next year, and understanding real estate's a slow moving train that, 2020 used to be survive to 25. I think you're definitely going to want to survive past that because I still think we got a few years left of this because like you said, it's going to have to reset because I can't see how they're going to get interest rates back down to 3.5, 4, 4.5 anytime soon, especially with where the 10-year treasury is and people not wanting U.S. bonds because there's so many of them.
Well, maybe survive till 25 has to be like it's fixed in 26 or Seveney will thrive in 27. I don't know.
Yeah, I mean, we can all guess. Nobody knows. That's a reality. And that's really the point I want to make to people is nobody knows. Right. It's just a matter of so much can happen. And it's a macro economy with China, BRICS, and some of these other countries and nations that something can happen that can really just throw everything upside down. But if nothing happens and it's just we're at a pause across and there's no major events, we still got a ways to go because there's still some resetting that I think still needs to happen.
Yeah, I agree with you. And I look forward to that happening. And that's probably about the time you'll see me back out there buying.
Yeah. I think most of us would rather have it happen sooner rather than later. It's kind of like, let's just get it over with.
I am with you. I would agree with that. That would be nice, but I'm prepared. We're fine. I don't have to buy anything. I don't have to do anything and I'll be just fine. So I'm waiting patiently. And, there's a needle in every haystack, I like to say. So there's a deal to be done today if you can find the right seller and put together the right financing. But I mean, to get any amount of reasonable transaction volume, I think we have to see a change in conditions and it'll get here eventually. We're ready for it.
As we wrap up this episode, Brian, how can people reach out to you?
Well, they could do it a few ways. They could go to our website, praxcap.com. It's praxcap.com. You can find me on Bigger Pockets in the forums, making posts alongside yours. We seem to comment in a lot of the same threads that I've seen. You can also follow me on Instagram at Investor Brian Burke.
Brian, thanks for coming on today on this episode of Creating Wealth Simplified podcast. For everyone listening, make sure to like and leave us a review. And thanks all for watching and listening. Thank you for joining Lauren and I on this episode of the Creating Wealth Simplified podcast. Each week, we bring you expert education, experience, and information in a digestible format to help you identify investment opportunities so you can build wealth through real estate and take action toward your financial goals. Enjoy the show, share with a friend, or subscribe to the show and leave us a review.